The alert appeared briefly. It was labeled minor. It remained visible for less than 3 seconds. No system failed. No alarms sounded. No thresholds were breached. But that single, unreviewed signal quietly erased millions in value. The organization managed a multi-layered investment portfolio valued in the high 9 figures. The structure was conservative by design. Risk controls were documented. Oversight procedures were standardized. Portfolio adjustments followed a defined calendar. Risk exposure was reviewed weekly. Alerts were categorized into 3 levels: critical, moderate, and minor. Critical alerts required immediate action. Moderate alerts required confirmation within 24 hours. Minor alerts were logged automatically and reviewed periodically. No individual was assigned to monitor minor alerts daily. This omission was not accidental. It was procedural. The process had functioned without incident for several years. The portfolio management system analyzed multiple inputs simultaneously: price movement, volatility clustering, correlation drift, liquidity conditions, and counterparty exposure. Each variable had tolerance bands. Each band was calibrated using historical data. When deviations occurred, the system generated alerts. Severity depended on magnitude and speed. Minor alerts represented early-stage deviations. They did not indicate failure. They indicated change. The team believed early-stage deviations self-corrected. This belief was supported by years of data. Most minor alerts resolved without intervention. Reviewing every minor alert was considered inefficient. Automation existed to reduce cognitive load. Trust in the system was not blind. It was reinforced by consistency. For 9 consecutive trading days, the alert log accumulated entries. Each was time-stamped. Each was archived. None were opened. No reminder was generated. No exception report was triggered. Silence followed. One volatility sensor used during stress testing scenarios was offline for scheduled maintenance. The system recorded the outage. No notification was escalated. The initial alert referenced a correlation shift between 2 asset classes designed to offset each other during volatility. The deviation was subtle. Measured in decimal points. Well within tolerance. Correlation drift occurred regularly. Temporary divergence was normal. The model permitted it. Diversification was assumed intact. Historical performance suggested resilience. Stress scenarios had passed previously. There was no reason to intervene. Over the next 12 trading sessions, automated rebalancing continued. Positions adjusted marginally. Allocations shifted incrementally. No single adjustment raised concern. The correlation drift persisted longer than average. This was logged. It was not reviewed. According to the system context, liquidity indicators began tightening across regional markets. Bid-ask spreads widened slightly. Settlement times lengthened marginally. All indicators remained within acceptable ranges. No escalation occurred. Seasonal effects were expected. Quarter-end adjustments often produce temporary tightening. Past cycles reinforced this belief. For 16 days, daily summaries were reviewed. Alert archives were not. One internal report mentioned monitoring conditions closely. No follow-up meeting was scheduled. Exposure to a specific sector increased gradually due to algorithmic optimization. Each increase complied with risk policy. Each trade passed compliance checks. The system favored efficiency over anticipation. It is also assumed incremental change felt controlled. Gradual exposure rarely produced shocks. The belief was logical. It was incomplete. By day 28, cumulative exposure had increased 14%. The figure was not reviewed in isolation. One recalibration update was deferred due to scheduling constraints. The system continued using prior parameters. Market expectations shifted abruptly following an external announcement. Interest rate projections changed. Yield curves adjusted. Volatility spiked briefly. Moderate alerts were triggered. Moderate alerts were interpreted as new information. Earlier signals were not revisited. Within 48 hours, liquidity deteriorated further. Exit strategies faced friction. Transaction costs increased. The original correlation drift amplified losses instead of absorbing them. Risk models recalculated exposure under stressed conditions. Loss estimates exceeded projections. The system shifted from monitoring to mitigation. Mitigation would stabilize outcomes. The belief came too late. Position adjustments lagged market movement. Liquidity premiums widened. A contingency model referenced the original alert retroactively. Post-event analysis reconstructed the timeline. Every action followed policy. Every trade complied with limits. No violation occurred. Compliance equaled safety. Weeks passed before the full impact was realized. A junior analyst had noted the alert internally. Authorization barriers prevented escalation. The failure was not technical. It was not strategic. It was procedural silence. Minor alerts are not warnings. They are questions. Questions unanswered compound quietly. Automation filtered noise, but also filtered curiosity. The offline tracker reduced visibility. Human trust delayed intervention. Incremental changes accumulated. By the time moderate alerts appeared, the system was responding, not preventing. Losses materialized during repositioning. Liquidity vanished when needed most. The cost was not immediate. It unfolded gradually, then suddenly. By the time the opportunity to adjust emerged, the window had closed. Revisit the sequence. A minor alert logged. A tracker offline. Correlation drift extended. Exposure increased gradually. Liquidity tightened. Moderate alerts arrived late. One decision connected every outcome. Another overlooked detail emerged. The alert system had been reclassified months earlier to reduce false positives. The change was approved unanimously. No one questioned the decision at the time. For investors, review minor portfolio alerts weekly. Early signals offer optionality. For businesses, automation reduces effort, not accountability. For credit monitoring, small anomalies precede larger issues. For system designers, silence must be reviewed, not trusted. Human oversight does not replace automation. It completes it. Months later, another anomaly surfaced. It existed in a separate subsystem. One that had never been audited. That review led to another realization. Every decision followed procedure. No rule was broken. No alarm sounded. At the time, the silence felt safe.